Wow, this is crazy. Welcome to today's Explainer, everyone. Okay, we need to dive straight into this because the situation we are looking at today is absolutely wild. We are talking about AppLovin. Their stock has just been on an absolute tear lately, boasting this incredible one-year total shareholder return of over 42%. But then, literally out of nowhere, it violently plunged nearly 15% in a single week. I mean, retail investors are getting severe whiplash here. So what is the reality? Is this the ultimate AI growth engine that we should all be buying? Or are we looking at a highly leveraged house of cards about to collapse? To decode all this madness, I brought in our lead investment analyst.
Thank you for having me. If we look strictly at the market data and the fundamental SEC filings, this recent volatility isn't random. It is a direct mathematical reaction to shifting risk premiums in the broader tech sector. We are going to break down the exact numbers behind this paradox today and see what the data actually dictates, removing all the emotional noise from the equation.
Here is the structured roadmap for our analysis today. Stage 1, we will examine the stock and its hidden causes. Stage 2, a thorough financial and fundamental deep dive. Stage 3, analyzing their industry environment and economic moat. And finally, Stage 4, we will outline 3 precise survival scenarios for the company's future. Perfect! Let's get right into it and find the actual truth behind these wild price swings.
Section 1. The stock and its hidden causes.
All right, the market is clearly beyond confused right now. On one hand, we have Wall Street analysts constantly slapping these strong buy ratings on this company. But simultaneously, the stock is experiencing these massive double-digit drops in a matter of days. What is actually driving these massive price swings under the hood?
The fundamental data indicates there are 3 primary catalysts completely hidden behind the mainstream news headlines. First, there is an unprecedented leap in AI algorithmic efficiency occurring entirely within their closed network. Second, the data shows a strategic, aggressive expansion away from purely mobile gaming and into global web-based e-commerce. And third, the raw mathematical outcome of those first 2 factors is a staggering 109% year-over-year surge in their first quarter net income. The market is violently fluctuating because it is struggling to correctly price in an AI infrastructure company that essentially masquerades as a standard advertising firm.
Wait, hold on a second. That is a bit too complicated for me. An AI infrastructure company masquerading as an advertising firm? Algorithmic efficiency? Could you give us a simple analogy? If I were an elementary schooler, how would you explain what AppLovin's basic role actually is?
Let me break this down for you. Imagine a highly efficient, high-speed matchmaker at a massive dating event. On one side of the room, the data shows you have over 1 billion people who play mobile games every single day. On the completely opposite side of the room, you have brands and businesses desperately looking for paying customers. AppLovin's proprietary AI engine, which they call Axon, acts as this matchmaker. The AI's basic role and core objective is to analyze mountains of first-party data instantly, and then pair a specific individual gamer with a specific brand's advertisement at the exact psychological moment they are most likely to actually make a purchase. It is not traditional advertising. It is a purely algorithmic matchmaking service operating at an unimaginably massive global scale.
Oh my God, really? So what you just said basically means they aren't just selling digital billboard space like an old-school media company. They are actively hunting for perfect transactional matches using a highly tuned AI brain.
Let's move to Section 2, a financial and fundamental deep dive into their actual Q1 performance.
Okay, so they are this massive, invisible matchmaker that essentially guarantees brands will find paying customers. If they're really so brilliant, prove these massive growth claims to me with hard numbers, because talk is cheap on Wall Street. If you look at the data here on their consolidated statements of operations, specifically comparing Q1 2025 to Q1 2026, the proof is undeniable. Top-line revenue escalated from $1.15 billion to $1.84 billion. That represents a 59% increase. However, the critical metric is the bottom line. Net income simply exploded, going from $576 million to $1.2 billion, achieving that 109% increase we noted earlier. This proves significant operating leverage. The fundamental data shows this profit surge is not coming from simply displaying a higher volume of ads to users. In fact, the metrics explicitly show their actual volume of software installations decreased by 18%. Wait, seriously? Their ad volume actually decreased by 18%, but their bottom line profit doubled? How is that even physically possible?
Precisely. And this brilliantly illustrates the sheer power of their upgraded software model, Axon 2.0. The profit surge is driven strictly by the AI making every single ad placement drastically more profitable.
If we examine the margin data on this statement, AppLovin achieved an astonishing 65.4% net margin in the first quarter of 2026. This mathematically indicates that for every single dollar they generate in top-line revenue, they are keeping roughly 65 cents as pure bottom-line profit. In the highly competitive ad tech space, maintaining a margin of that magnitude confirms beyond a doubt that their AI recommendation engine requires almost zero incremental cost to generate massive exponential returns.
Pause right there for a second. Let me play the devil's advocate here. What does this algorithmic efficiency actually have to do with our stock accounts? Why should a retail investor watching this right now care at all if their net revenue per install went up?
It translates directly to ultimate pricing power and competitive dominance, which dictates stock value. The fundamental data shows their net revenue per installation increased by an incredible 93%. Because the Axon 2.0 AI engine is vastly superior at identifying users who will actually spend money, advertisers are mathematically compelled to pay AppLovin significantly more money for fewer but much higher quality ad placements. This means AppLovin can scale its revenue exponentially without needing to acquire exponentially more gamers to view the ads. For your stock account, this signifies you are looking at a high-margin software compounder operating at absolute peak efficiency.
All right. Let's look at this balance sheet you brought. Because if they're running this giant, flawless cash printer with 65% profit margins, why is the market suddenly terrified? Why did the stock plunge 15%? Because when I look here, I see an absolutely massive pile of long-term debt sitting right on their books. It looks like over $3.5 billion in long-term debt alone.
The market's recent hesitation is completely justified by their underlying capital structure. The balance sheet data explicitly shows AppLovin currently operates with a 148% debt-to-equity ratio. Now, it is true that their massive cash flow easily services this debt currently. However, from a strictly analytical perspective, high financial leverage artificially inflates a company's return on equity. This creates a severe fundamental vulnerability. If macroeconomic conditions suddenly worsen, or if their core reliance on the mobile gaming sector faces an unexpected downturn, that heavy $3.5 billion debt load will rapidly compress their profit margins and massively magnify the downside risk for ordinary equity holders. The debt acts as a massive operational amplifier. It is incredibly beneficial on the way up, but completely devastating on the way down.
So what you just said basically means the cash printer is running red hot right now, but the actual machine was bought on a massive, highly leveraged credit card, making the entire company hypersensitive to any economic hiccups.
That leads us perfectly into Section 3, the industry environment and economic moat.
So in this cutthroat advertising market, where you are literally going up against undisputed giants like Google and Meta, what is AppLovin's actual irreplaceable weapon? What exactly is their moat that keeps clients from just leaving?
Their primary economic moat is a concept known as mathematically guaranteed performance marketing. It operates on a strict, verifiable formula that proves return on ad spend. Let me break down the data flow. Step 1, an advertiser spends exactly $1 on the AppLovin platform. Step 2, the Axon AI engine targets and acquires a high-probability user. Step 3, the advertiser demonstrably makes more than $1 back in customer lifetime value. Advertisers currently spend over $11 billion annually on this specific platform because, as AppLovin's own management states, they do not sell creative pitches or vague brand awareness. They sell the measurable mathematical fact that the advertising yields a positive financial return. As long as the AI keeps that fundamental equation positive, the advertisers simply cannot afford to leave the ecosystem.
Wow, so they are essentially selling a literal money-making guarantee? Spend $1, get $1.20 back. But where on earth are they finding all these perfectly compliant people to watch these ads?
The environment itself is their secondary moat. The data unequivocally proves that mobile gaming is the ultimate captive audience right now. They organically reach over 1 billion unique people playing mobile games daily. But the crucial differentiator is the format. These are full-screen video ads with a verified median engagement time of 35 seconds.
OMG, 35 seconds. So there are no endless social media feeds to instantly scroll past. Unlike traditional platforms where you just swipe past the sponsored post in a fraction of a second, these gamers are locked into a relaxed viewing window right between game levels. They are basically forced to actually sit back and watch the brand's entire story. That completely destroys the traditional scrolling model we see on Meta or TikTok.
Exactly. And the data shows that leads us directly to their current industry megatrend shift.
Historically, AppLovin utilized this powerful AI engine exclusively for legacy indie game studios, essentially helping one mobile game find new players from another mobile game. But the recent filings show they are now transitioning this exact same highly trained AI engine outward to global web-based e-commerce consumer brands. They are currently opening a completely self-serve platform where massive auto insurance, healthcare, and retail brands can seamlessly buy this exact same locked-in, high-converting gaming audience without ever needing to speak to a human sales team. Okay. This is all sounding way too perfect. I demand to know the catch right now. If they have a captive audience and they are suddenly opening up to the entire global retail world, why did the stock randomly plunge 15% in a single week? The data shows that 15% plunge correlates directly with rapidly emerging technological and regulatory threats. There are severe, fatal weaknesses present. First, Alphabet recently unveiled Project Genie, an advanced AI tool that creates dynamic virtual worlds on the fly. Second, a new tech startup called CloudX just released a highly capable AI agent. If autonomous AI agents begin making routine purchases on behalf of humans, or if gamers suddenly shift their attention entirely to dynamically generated AI virtual worlds, AppLovin's current static ad placement model within traditional games could be severely disrupted. Furthermore, tightening global data privacy rules, specifically GDPR in Europe and CPRA in California, continually threaten to completely block the exact first-party data tracking that makes the Axon matchmaker function. Their extreme over-reliance solely on the mobile gaming sector makes them acutely vulnerable to these rapid technological shifts.
Furthermore, severe valuation risk is prevalent in the current market numbers. If you look at the comparative data here, AppLovin is currently trading at a price-to-earnings ratio of 42.8 times. To provide context, the broader U.S. software sector average is currently sitting at only 27.2 times. What this mathematically dictates is that the market has already priced a significant amount of future, flawless perfection into this specific stock. If the new e-commerce expansion underwhelms even slightly, or if privacy rules tighten just a fraction more than expected, that incredibly high PE multiple will compress violently, which fully explains the recent 15% haircut we observed. So in short, they have this amazing, captive, highly profitable audience right now, but their sky-high valuation requires absolute zero-mistake perfection going forward. Any little bump in the road and the stock price gets absolutely punished.
Let's move to Section 4, 3 survival scenarios. It is time to see if they fly or die. Let's cut right to the chase here and look at the actual future scenarios. Lay out the exact conditions needed for this stock to fly to the moon or die trying. We will begin by looking at the bull case, which is the most optimistic scenario. The data dictates that the specific preconditions or triggers for this are the highly successful June launch of their self-serve platform and the rapid, highly profitable scaling of major e-commerce advertisers. If AppLovin can definitively prove that the Axon AI can seamlessly sell retail consumer products just as effectively as it sells mobile game downloads, algorithmic models project a fair value target of roughly $625 per share. This calculation assumes a consensus sustained growth rate of 21% per year and maintaining a 25 times future PE multiple, representing roughly a 27% upside from recent closing prices. Wow, that is a massive upside if they could truly pull off this e-commerce pivot without a hitch. But what if they just stay exactly who they are right now? What if the retail stuff doesn't work out? That brings us to the base case, the neutral scenario based strictly on current existing trajectories. The triggers here rely on steady, continued dominance strictly within the mobile gaming ad sector. They generate enough baseline cash flow to consistently pay down their $3.5 billion in high-interest debt over time. In this scenario, the data suggests they would maintain their current 42.8 times PE ratio. The stock would likely see moderate, stabilized growth, but the euphoric hypergrowth narrative would completely cool down as they mathematically reach natural market saturation within the confines of the mobile gaming vertical.
Okay, and what about the absolute nightmare scenario? That is the bear case. This pessimistic outcome materializes if the identified fundamental risks hit simultaneously. The specific triggers, big tech initiatives like Project Genie and CloudX successfully steal user engagement time, totally disrupting the traditional mobile gaming market that AppLovin relies on. Concurrently, new state and global privacy regulations successfully block Axon's ability to track users, destroying their ability to calculate that mathematically guaranteed return on ad spend. Because of their incredibly high 148% debt-to-equity leverage, any sudden drop in top-line revenue will disproportionately crush their bottom-line net margins, leading to a severe, rapid downward re-rating of the stock and a total collapse of that 42 times multiple.
Wow. Okay, so to summarize this entire wild ride for everyone watching today, I have to bring up a legendary stock market quote that just perfectly fits AppLovin's current situation. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Right now, the market is voting wildly on AI fears, high leverage, and big tech news, causing those brutal 15% plunges. But eventually, the noise fades, and the scale will have to weigh the actual cold, hard cash their AI matchmaker is pulling in.
Which brings us to the ultimate question you have to answer for your own portfolio today. Will AppLovin's Axon AI engine successfully pivot to become the undisputed global standard for all e-commerce advertising, or will it find itself totally outsmarted and boxed out by big tech's new, dynamically generated AI agents? Thank you so much for joining us for today's explainer. Your subscriptions, your likes, and your supportive comments are a huge encouragement for our production team. Share your thoughts on AppLovin's next big move with us in the comments below. Until next time, stay focused, stay rational, and keep learning.